Welcome to the deep dive. So you've shared a really interesting stack of information with us, all focused on personal finance.
That's right.
And our goal today is to really dig into that and pull out the most valuable kind of actionable insights, things you can use to build a really solid financial foundation.
Exactly. And your sources, they cover a lot of ground, don't they? Everything from, setting up that safety net, the emergency fund,
Hmm.
to making your money work harder through budgeting, investing.
Right.
We'll also touch on some crucial areas like taxes and insurance, things people maybe don't think about as much.
Yeah, absolutely. The aim is really to connect all these pieces, right, and figure out what's most important without getting, completely overwhelmed.
Precisely. Highlight the key stuff.
Okay, so let's unpack this, starting with that emergency fund.
Yeah.
It's fundamental, really.
It really is.
And your sources nail this.
Yeah.
It acts like your financial insurance policy. It's that dedicated pot of money for when life throws you a curveball.
Yeah, like an unexpected car repair or, a surprise medical bill, even losing a job, potentially.
Exactly. And what's really key, I think, is how it shields you from falling into bad debt.
Oh, absolutely. That's a huge point in the sources. When those things hit and you don't have a cushion, well, it's tempting, isn't it?
Totally. You reach for the high-interest credit card, and, well, we'll get into that later, but that can become a serious burden.
Real trap.
So the standard advice we're seeing is aiming for, what, 3 to 6 months worth of essential living expenses?
Right. And essential is the key word there. It's not everything.
No, is the absolute must-haves.
Yeah.
Housing, utilities, food, transport, insurance.
But not like your streaming subscriptions or eating out budget.
Right, the discretionary stuff is out for this calculation.
And the sources give a pretty good example. Like, if your essential monthly bills are around $4,000,
Okay.
then that 3 to 6 month target works out to between $12,000 and $24,000.
Which, let's be honest, can sound like a huge number.
It definitely can. And it's important to frame that as, a longer term goal. It's not something you build overnight.
For sure. And for people with, say, less predictable income, maybe freelancers or gig workers.
Good point. They might need to look at average expenses over a longer period, maybe 6 months or a year, and potentially aim for the higher end of that 3 to 6 month range just for extra security.
Right, a bigger buffer.
Right.
And because that big number can feel, well, maybe a bit daunting.
Yeah, paralyzing almost.
The sources wisely suggest starting smaller, like aim for $1,000 first.
Exactly. That initial $1,000, it can cover a lot of those smaller, more common emergencies.
And it gives you that confidence boost, right? Builds some momentum.
Totally. It feels achievable.
No.
So where do you actually keep this money? Liquidity is key.
Meaning you need to get to it fast if you need it.
Right. But you also want it separate from your everyday checking account.
So you don't accidentally spend it on, I don't know, pizza.
Exactly. Resist the urge. So high-yield savings accounts are really highlighted here.
And the difference is pretty stark right now, isn't it? Early
Yeah.
2025.
Oh, absolutely. Some online banks are offering APYs, annual percentage yields of like 4 or 5%.
Compared to what? Less than 1% at a lot of traditional banks.
Way less often. National average is super low. So that extra interest, it really helps the fund grow faster over time, even passively.
It really adds up. And there was a statistic in the sources that just, wow, really drives this home.
Which one was that?
Nearly 40% of Americans couldn't cover a $400 emergency without borrowing or selling something.
$400.
Yeah.
That really puts it in perspective, doesn't it? Shows how vital this safety net is.
Absolutely. So the practical side, how do you actually build the fund?
Well, the sources give a great tip. Automate it.
Set it and forget it.
Pretty much. Set up an automatic transfer from your checking to your emergency fund savings account every payday.
Even if it's a small amount.
Yeah, even something like $50 per paycheck. That adds up to $1,200 a year, right? Plus that higher interest we talked about.
It's like making a regular appointment with your future financial self.
Exactly. Paying yourself first, really.
And it's so important to remember, like, the source's stress. This is a marathon, not a sprint.
Definitely. It's about consistency, even with small amounts.
Because the real payoff isn't just the money, it's the peace of mind.
Oh, for sure. The sources even had anecdotes, stories of people avoiding debt during a crisis just because they had that buffer. It's huge.
Okay, let's shift gears then. Budgeting.
Ah, the B word.
Yeah, it often gets a bad rap, doesn't it? Feels restrictive. But the sources offer a really helpful reframe.
They do, thinking of it as intentional spending.
Right, not about deprivation, but about having a plan for your money. Making sure you spend less than you earn.
Actively saving for goals and just, well, knowing where your money actually goes.
Yeah, and culturally, I think budgeting can feel like a chore. We're just, bombarded with messages linking spending to happiness.
Totally. And the sources touch on behavioral economics too that pull towards immediate gratification. It's hardwired almost.
It makes delaying spending feel tough. But the insight here is that budgeting, done right, actually gives you more control, more freedom.
Exactly. Puts you in the driver's seat. So the sources outline a few common methods. First up, the zero-based budget.
Okay, what's that?
The idea is you give every single dollar of your income a specific job. So if you bring in, say, $5,000 after taxes,
Right.
you allocate all of it. Rent gets this much, groceries this much, savings this much, until the total equals $5,000.
So income minus expenses and savings equals zero, leaves nothing unassigned.
Exactly. Very clear picture of where everything's going.
Okay,
Then there's the 50-30-20 method. A bit more flexible, maybe.
how does that work?
You split your after-tax income. 50% goes to needs, the essentials we talked about.
Housing, food, etc.
Right. 30% is allocated to wants, the fun stuff, things you enjoy but could technically live without.
Okay.
And the final 20% is for savings and debt repayment.
So using that $5,000 example, that's $2,500 for needs, $1,500 for wants, and $1,000 for financial goals.
Precisely. It provides some guidelines, but with categories.
Got it. And the third one,
The envelope system. This one's more tactile.
physical cash.
Yep. You take out cash for different spending categories like groceries or entertainment and put it in labeled envelopes.
And when the envelope's empty.
That's it for that category until the next budget period. It's very visual, really helps you see where the money's going and stick to limits.
Interesting. But the crucial point, really, that the sources make
Is that the best budget is the one you'll actually stick with.
right. Consistency is everything.
Totally. And if you're just starting out, they highly recommend tracking your spending for a month first. Just see where it's going now.
Yeah, that can be eye-opening, can it? You might be surprised.
Oh, definitely. Those daily coffees or maybe subscriptions you forgot about, they add up.
Identifying those patterns is the first step to making changes.
Exactly. And technology helps here, right? Apps like Mint, YNAB, Personal Capital, they can automate a lot of the tracking and categorizing.
Sure, but you don't need fancy tech.
Not at all. A simple spreadsheet, even pen and paper, works just fine if that's what you prefer.
It's the consistency, not the tool.
Precisely. Consistency in tracking and reviewing.
There was a practical tip in there about bank accounts.
Oh yeah, the bucketing approach, setting up separate accounts.
Like one for fixed bills, one for variable spending, one for savings goals.
Exactly. It helps organize things visually, gives you a clearer picture.
Makes sense. And linking back to the emergency fund, that pay yourself first idea comes up again.
Absolutely. Automate those transfers to savings and investments right when you get paid.
Before you even see it, basically.
Yeah, prioritize your future self before you have a chance to spend it elsewhere.
Good advice. What about flexibility? Budgets can feel really rigid,
That's a key point. If it's too rigid, you'll probably ditch it. So build in some wiggle room.
like a miscellaneous category.
Yeah, or a buffer for those small, unexpected things. And don't beat yourself up if you overspend occasionally.
Learn from it, adjust, move on.
Exactly. See what happened? Adjust the budget for next time. It's a learning process.
And what about those bills that don't hit every month, like car insurance paid twice a year?
Good question. The sources suggest annualizing the cost, figure out the total for the year, and then save 112th of that amount each month.
So you have the money ready when the bill is due, prevents those big hits to the monthly budget.
Right. Smooths things out.
Ultimately, it seems like budgeting is really personal.
Very personal. What works for one person might not work for another at all.
So experiment.
Definitely. Try different methods, find what clicks with your lifestyle, and actually helps you reach your goals.
Okay, that makes sense. Let's talk about debt management next.
Right, a big topic. And the sources make a really important distinction right off the bat. Good debt versus bad debt.
Okay, what's the difference?
Generally, good debt helps you acquire assets that might increase in value or boost your earning potential.
Like a mortgage on a house.
Exactly. Or student loans for a degree that leads to a better career, maybe some business loans.
And bad debt.
That's usually for things that depreciate quickly or are just consumed. Think high-interest credit cards.
Payday loans.
Ugh, definitely payday loans. Or maybe car loans that are way more than you can comfortably afford.
And the real killer with bad debt is the interest rate, right?
Absolutely. High interest just digs the hole deeper and deeper. The sources had a Powerful comparison.
Yeah, I saw that. Like $10,000 on a credit card at 18%.
Right. Making minimum payments, it could take nearly 5 years to pay off and cost you over $4,800 just in interest.
Ouch. Compared to
Compared to a $10,000 student loan at 5%. Same payment, you'd be done in under 4 years, paying only about $1,000 in interest.
huge difference. It shows how much that interest really cost you.
It really does. And it's a widespread problem. Average U.S. credit card debt is over $6,000.
And student loan debt is massive, over $1.7 trillion nationally.
Yeah, staggering numbers. So managing debt strategically is crucial.
Okay, so if you have multiple debts, what's the plan? The sources mention two main strategies.
Right, the avalanche method and the snowball method.
Avalanche first. What's that?
With avalanche, you focus all your extra payments on the debt with the highest interest rate first, while paying minimums on everything else.
So if you have debts at 22%, 18%, 15%, you hammer the 22% one.
Exactly. Mathematically, this saves you the most money on interest over time.
Makes sense. And the snowball method.
Snowball focuses on the smallest balance first, regardless of the interest rate.
So if you have debts of $1,000, $3,000, and $10,000, you tack that $1,000 first.
Yep. Pay minimums on the others, throw everything extra at the smallest one until it's gone, then move to the next smallest.
Why do that if Avalanche saves more interest?
It's psychological. Getting that quick win, paying off a whole debt, can be really motivating.
Keeps you going.
Exactly. Studies suggest people actually stick with the snowball method more often because of those wins.
Interesting. So the best method is the one you'll actually follow through on.
Pretty much. Consistency again?
What about things like balance transfer offers? Those 0% intro rates?
They can be useful, but you have to be careful. The sources stress discipline.
Meaning you need a solid plan to pay it off before that 0% period ends.
Absolutely. Because the rate often jumps way up after that. And watch out for balance transfer fees, usually 3–5% upfront.
Right. Got to factor that in. What about debt consolidation?
That's combining multiple debts into one single loan, hopefully with a lower interest rate, like rolling several high-interest credit cards into one personal loan.
Simplifies payments, potentially lowers interest.
Yeah. But you need to qualify for that lower rate, of course.
And the sources warned about using home equity, like a HELOC, for this.
Yes, big caution there. While the rate might be lower, you're turning unsecured debt, like credit cards, into secured debt.
Secured by your house.
Exactly. You're putting your home on the line if you can't make the payments. That's a big risk, not to be taken lightly.
Good point. And while you're paying down debt, what's crucial?
Keep making at least the minimum payments on all debts. Always. Protects your credit score.
And try not to take on new debt, right?
Definitely. That might mean some lifestyle adjustments, maybe keeping the old car longer, cutting back on non-essentials for a while.
Makes sense. What about student loans specifically? Anything borrowers should look into?
Yeah, the sources mentioned exploring income-driven repayment, IDR plans. These can lower your monthly payment based on your income and family size.
Okay.
And definitely look into forgiveness programs you might qualify for, like public service loan forgiveness, PSLF, or teacher loan forgiveness.
Worth checking out. And finally, on debt. The psychological side again.
Right, it's tough. So acknowledge your progress. Celebrate the milestones.
Even small ones.
Yeah, pay off a card. Do something small and affordable to reward yourself. It helps keep motivation high.
Okay, good advice. Let's switch to investing now. This can feel intimidating for a lot of people.
It really can seem complicated, like this exclusive club, but the sources frame it simply. It's how you grow your wealth over time and beat inflation.
And the real engine behind it is compound interest.
Oh, the magic of compounding. It's incredibly powerful. Even small amounts invested consistently can grow massively over the long haul.
Because your earnings start earning returns themselves.
Exactly. The sources had a killer example. Invest $300 a month from age 25 to 65.
Okay. Assuming, say, an 8% average annual return.
Right. You could potentially end up with around $1 million.
Wow. But if you wait just 10 years, start at 35.
Same $300 a month, same return. The total drops to maybe $440,000.
Huge difference. Almost $600,000 less just for starting 10 years later.
It really highlights the incredible advantage of starting early. Time is your biggest ally.
That feeling of intimidation is real, though. The stat was something like only 56% of Americans own stocks.
Yeah, meaning almost half are missing out on this major wealth building tool. But the good news is it doesn't have to be complex.
Especially not starting out.
Right. And the key mantra is time in the market beats trying to time the market. Don't try to guess the highs and lows. Just stay invested.
So for beginners, what's a good starting point? The sources mentioned index funds,
Yes, highly recommended. They offer instant diversification because they track a whole market index, like the S&P 500.
which holds stocks in 500 big U.S. companies.
Exactly. So you're not betting on just one company. And crucially, they usually have very low fees or expense ratios.
And fees really eat into returns over time, don't they?
Massively. Low fees are critical for long-term success. Index funds are typically passively managed. They just track the index, unlike actively managed funds where a manager tries, and often fails, to beat the market, charging higher fees.
Makes sense. How do you decide what to invest in, like stocks versus bonds?
It really depends on your time horizon when you'll need the money.
So money for a house down payment in 3 years shouldn't be in the stock market.
Probably not. Too much short-term volatility risk. But for long-term goals like retirement, decades away.
A higher allocation to stocks makes more sense.
Generally, yes. Historically, stocks offer higher potential returns over the long run, and you have time to ride out the inevitable market ups and downs.
There was a rule of thumb mentioned, 110 minus your age.
Yeah, as a very rough guideline for the percentage you might allocate to stocks. So a 30-year-old might consider around 80% stocks. It gets more conservative as you age.
Okay. And retirement accounts. Big tax advantages there.
Huge. If your job offers a 401k with an employer match,
You absolutely have to contribute enough to get that full match.
it's free money. It's like an immediate guaranteed return on your investment. The example was a 50% match on up to 6% of a $60,000 salary.
That's an extra $1,800 a year from your employer just for saving $3,600 yourself.
Exactly. You'd be crazy to leave that on the table.
What about IRAs? Individual retirement accounts.
Great option, especially if you don't have a 401k or want to save more. Two main types, traditional and Roth.
Traditional IRA, tax deduction now, pay taxes on withdrawals in retirement.
Right. Roth IRA, contribute after-tax money, but then it grows tax-free, and qualified withdrawals in retirement are also tax-free.
And the sources suggested Roth might be better for younger folks.
Often, yeah. If you expect to be in a higher tax bracket later in your career, paying the taxes now while your rate is lower can be advantageous.
Got it. What about managing market ups and downs, dollar cost averaging?
Yes, great strategy. Instead of investing a lump sum, you invest a fixed amount regularly, like monthly.
Regardless of market conditions.
Right. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. It averages out your cost per share over time.
Reduces the risk of buying everything right at a peak.
Exactly. Takes emotion out of it. Which leads to another tip.
Automate your investments.
Yes, set up those regular automatic transfers. Makes consistency easy.
And avoids the temptation to skip investing when the market looks scary.
Totally. And another piece of advice. Don't check your balances obsessively.
Like multiple times a day.
Yeah. It just feeds anxiety and can lead to emotional decisions, like panic selling during a dip.
Better to check quarterly. Annually.
Something like that. Focus on the long term. Successful investing is about consistency, time, and low costs.
Not about picking the next hot stock or timing the market perfectly.
Exactly. For beginners who want super simple, target date retirement funds are great.
They adjust the stock-bond mix automatically as you get closer to retirement.
Yep. All in one, set it and forget it solution.
And robo-advisors were mentioned too. Lower-cost alternative to human advisors.
Right. Places like Betterment, Wealthfront, Vanguard Digital Advisor, they use algorithms to manage your portfolio, typically for a lower fee, maybe around 0.25% of assets.
Compared to 1% or more for many traditional advisors.
Can make a big difference over decades.
Okay, let's pivot to taxes. Not the most exciting topic, maybe.
Huh. Maybe not. But understanding the basics can save you real money.
And those tax advantage accounts we just talked about, 401k, IRAs are key here too.
Absolutely. Plus HSAs, health savings accounts. The sources had a great example for 401k.
A $10,000 traditional 401k contribution.
Could save someone in the 22% federal tax bracket, $2,200 in federal taxes that year. Plus maybe state tax savings too.
That's significant. And HSAs have that triple tax advantage.
Yes. If you're eligible, usually means having a high deductible health plan. They're amazing. Contributions are tax deductible.
The money grows tax-free.
And withdrawals are tax-free if used for qualified medical expenses, now or even in retirement.
Wow. The 2025 contribution limits were mentioned too. Pretty decent amounts.
Definitely worth maximizing if you can.
And understanding deductions versus credits is important.
Crucial. Deductions reduce your taxable income. Credits directly reduce your tax bill, dollar for dollar.
So credits are generally more valuable,
Much more valuable. And there are some big ones people might miss.
like the child tax credit, education credits like the American Opportunity Tax Credit.
And the earned income tax credit for lower to moderate income workers, definitely worth investigating if you might qualify.
Good tip. What about managing withholdings during the year?
Yeah, check your paycheck withholdings, especially after big life changes. Use the IRS tax withholding estimator tool.
Make sure you're not paying too much or too little throughout the year.
Right. Avoid a huge tax bill or giving the government an interest-free loan, and keep good records.
For deductions, right. Charitable donations, medical expenses, mortgage interest.
Business expenses if you're self-employed, even small goodwill donations add up. Keep those receipts.
And for the self-employed, tracking expenses is vital.
Absolutely. Portion of cell phone, home office, internet, professional development. Apps like Expensify or QuickBooks Self-Employed can help.
And stay informed about tax law changes. They happen.
They do. Credits change, deductions change, contribution limits change. Knowing the current standard deduction amounts, for example, helps decide whether to itemize.
Got it. There was a tip about tax brackets, too.
Yeah, if you're near the top of a bracket, increasing pre-tax contributions to a 401k or a traditional IRA or an HSA or FSA can potentially lower your taxable income enough to keep you in the lower bracket.
Smart. What about Roth conversions?
Can be strategic in years your income is unusually low. You pay tax on the conversion now at that lower rate, then future growth and withdrawals are tax-free.
And tax loss harvesting for investors.
Selling investments that have lost value to offset capital gains or even a bit of ordinary income, but watch out for the wash sale rule, can't buy back basically the same thing within 30 days.
Right. And finally, the big distinction. Tax avoidance versus tax evasion.
Yes. Avoidance is legal, using the rules to minimize tax. Evasion is illegal, not paying taxes you owe. Step to avoidance.
Definitely. Okay, let's talk insurance. Often overlooked, but critical.
Absolutely vital for financial security. Health insurance is the big one, prevents medical bills from causing bankruptcy.
But even with insurance, out-of-pocket costs can be high, right?
Yep.
Those maximums.
They can be substantial. The sources cited 2025 averages around $8,000 for an individual, maybe $16,000 for a family on employer plans.
Which just reinforces why that emergency fund is so important.
Exactly. You need a way to cover those potential costs. And when choosing a health plan,
Don't just look at the monthly premium.
right. Consider your actual health needs, potential deductibles, co-pays. A lower premium might mean much higher costs if you actually use healthcare often.
Good point. What about life insurance?
Crucial if people depend on your income. Term life insurance is usually the way to go. For most people, it covers you for a specific term, like 20 or 30 years.
And the coverage amount. Sources said 10, 15 times annual income.
Yeah, that's a common guideline. So $70 K income might mean $700K to $1 million plus in coverage.
And term life can be surprisingly affordable, especially when young and healthy.
Very affordable. That example of a healthy 30-year-old getting $1 million coverage for maybe $30, $40 a month, much cheaper than whole life insurance, which bundles in a savings component at a much higher cost.
Okay. Disability insurance protecting your income.
Hugely important, maybe the most important after health. Your ability to earn is likely your biggest asset.
And the stat was something like 1 in 4 20-year-olds become disabled before retirement.
Yeah, sobering statistic. Can happen to anyone.
Employer plans offer some coverage, but maybe not enough.
Often only covers about 60% of base salary, and benefits might be taxable if the employer pays premiums. Individual policies offer more customization, and benefits are tax-free if you pay the premiums.
Worth looking into supplementing. What about liability on auto and home renters?
Need adequate limits there. As your assets grow, standard limits might not be enough if you're sued. Consider increasing them.
And renter's insurance affordable but underused.
Definitely. Costs maybe $15, $20 a month. Covers your stuff and liability. Way fewer renters have it compared to homeowners.
Umbrella insurance for extra liability.
Good idea as net worth grows. Adds an extra $1 million or more in liability coverage over your other policies for a relatively low cost, maybe $150, $300 a year.
When shopping for any insurance, compare coverage details, not just price.
Absolutely. And check the insurer's financial strength rating from agencies like AM Best or Moody's.
And review coverage regularly, annually, after life events.
Yes, needs change. And look into bundling policies for potential discounts.
Lastly, long-term care insurance.
Worth considering starting in your 50s. Nursing home costs are incredibly high, around $100 a year on average.
Okay, let's move to building credit wisely. Your score matters, right?
It matters a lot. Affects loan rates, renting, sometimes even jobs. The 5 main factors are payment history.
Paying on time, that's the biggest one.
Yeah, about 35%. Then credit utilization, how much credit you're using versus your limits, that's 30%.
Then length of credit history, credit mix, and new credit applications make up the rest.
Right. And the impact on borrowing costs is huge. That mortgage example
$300K mortgage, 1% difference in rate between good and fair credit.
can mean over $170 more per month, $61,000 more interest over the life of the loan, just from that score difference.
Wow. So keys to a good score.
Pay bills on time every time. Keep credit utilization low, definitely below 30% on each card is ideal.
And don't apply for a bunch of new credit all at once.
Right. And debunking that myth, you do not need to carry a balance and pay interest to build credit.
Pay the statement balance in full every month.
That's the best way. Builds credit, avoids interest. Also, check your credit reports.
From all 3 bureaus, Equifax, Experian, TransUnion.
Yep. Get them free annually at annualcreditreport.com. Errors are surprisingly common, like 20% of people have them.
And errors can really hurt your score. Disputing them is key.
Absolutely. Removing an incorrect negative item can make a big difference.
Credit cards themselves. Good tools if used responsibly.
Yes, they build credit history and can offer rewards. But if you carry a balance, the interest costs wipe out the rewards value quickly.
What if you have bad credit or no credit? Secured cards.
Good option. You put down a deposit that becomes your credit limit, use it responsibly, make payments, build history.
Becoming an authorized user on someone else's well-managed card can help too.
It can, yeah. Their good history can reflect on yours. Student cards are also good starting points for young adults.
And a practical tip. Set up autopay.
At least for the minimum payment, to avoid missing it. Ideally, automate the full statement balance payment.
And remember, building good credit takes time.
It's gradual. Negative marks fade over time, usually falling off after 7 years. Be patient and consistent.
Okay, penultimate topic. Retirement planning. Sources say many are behind.
Worryingly so. The median savings for people in their 40s is pretty low, around $63,000. But the message is, it's never too late to start or ramp up. Consistency is key.
And starting early makes a massive difference. That compounding effect again.
Huge. The example, 500 month from 25 to 65 could yield maybe $1.7 million. Start at 35, it's only maybe $745,000.
Merely $1 million less. Just underscores the power of time.
Absolutely. And take advantage of employer plans like 401ks, especially that match.
We keep saying it because it's that important free money.
Totally. And IRAs, traditional or Roth, are great for extra savings, or if you don't have a 401k, know the contribution limits for the year.
Self-employed have options too. SEP IRAs, solo 401ks.
Yeah, often with higher contribution limits, which is great. Definitely explore those if you're self-employed or a small business owner.
How much do you actually need for retirement?
Yeah.
The 4% rule?
It's a guideline. Suggests you can withdraw about 4% of your savings the first year, adjust for inflation after, and likely not run out of money for 30 years.
So to get $40,000 a year income from savings, you need about $1 million saved.
Roughly. Yeah, on top of whatever Social Security provides.
And Social Security is just part of the picture, right? Not the whole thing.
Definitely not. The average benefit isn't enough to live on comfortably for most people.
Good practical tip. Increase retirement contributions with every raise.
Yes. Even just 1% more each time, you barely notice it, but it adds up significantly over years.
As retirement gets closer, strategies like bond ladders were mentioned.
Yeah, creating a series of bonds that mature at different times to provide predictable income early in retirement.
And the bucket strategy for managing assets.
Dividing savings into short-term, cash low risk, medium-term, and long-term growth buckets to manage withdrawals and risk.
And don't forget, healthcare costs in retirement. They're huge.
Massive. That estimate of $315,000 needed for a couple retiring now, beyond Medicare premiums, it reinforces the value of HSAs for saving for medical expenses tax-free.
Wow. Okay, last section. Mindful spending and financial wellness. This feels different.
It is. It shifts from just the numbers to your relationship with money. Financial wellness isn't just having enough. It's using money to build a life aligned with your values.
And our culture pushes us constantly to spend, doesn't it? Ads, social media.
Thousands of ads a day. Lifestyle inflation is real. It's easy to get caught up. But the sources remind us experiences often bring more lasting happiness than just buying more stuff.
How do you become more mindful? The 24-hour rule.
Yeah, for non-essential buys over, say, $100, wait a day, see if you still really want it. Kills impulse buys.
Calculating cost per use.
Good one. Helps judge value. Is that cheap thing you'll use once really cheaper than the quality item you'll use for years?
Doing a values audit of your spending.
Yeah, look at where your money went last month. Does it align with what you say is important to you? Powerful exercise.
And defining enough.
So important. Defining what's truly enough for you can relieve that pressure to constantly chase more.
Healthy money conversations are key too, like money dates.
Yes, especially for couples. Regularly talking openly about goals, progress, concerns reduces stress and gets you on the same page.
Cultivating gratitude for what you already have.
Powerful mindset shift. Focus on appreciation, not just acquisition. Leads to more contentment, less impulsive spending.
And finally, money scripts. Our unconscious beliefs about money.
Right, beliefs formed over years, often unconsciously. Understanding your scripts, maybe about scarcity or status, lets you challenge them and make more conscious choices.
Okay, so we've really covered a lot in this deep dive.
We certainly have, from that foundational emergency fund.
Through intentional budgeting, smart debt strategies, investing for the future.
Optimizing taxes, crucial insurance protection, building good credit, planning for retirement.
And finally, cultivating that healthy, mindful relationship with money itself.
It's a comprehensive overview of the key areas highlighted in your sources.
Definitely feels like a shortcut to getting well-informed on these core financial pillars.
Hopefully it provides that solid understanding.
So maybe the final thought for you, our listener, is this. As you've heard all this, which area really resonates most with you right now?
Yeah. Where do you feel the biggest need or maybe the biggest opportunity? And perhaps more importantly, what's one small, actionable step you could take, maybe even this week, to strengthen that part of your financial foundation?
It's about taking these insights and applying them to your own situation, your own goals. We really encourage you to do that.